you able to do a spreadsheet on premium financing versus purchasing additional insurance with an IUL? Good question. I didn't do a spreadsheet on it, but I have compared them. And premium financing, for those of you that don't know, premium financing is typically something that's reserved for wealthy people who generally make $1 million or more a year. Although it can come down, if you're making over $100,000, you might be able to qualify for a small premium financing for a life insurance policy. And what premium financing is you're basically going to use leverage to buy your premiums. It's often done with IULs. You will put up a quarter of the premium, and a bank will loan you the rest to put up at a pretty decent interest rate, maybe 3 or 4%. Okay? So that's called premium financing, and the appeal to it is you don't put out much of your own money. It gets subsidized by the bank's money. The policy grows at X rate, and eventually you pay back that loan, and you still have this big death benefit along with a much bigger cash value than you might otherwise have, and you're able to take out a nice steady stream of income higher than you had expected to. So that's premium financing. One of the downsides to premium financing is that normally in a high cash value life insurance policy, you have cash value that's growing in there, and you have access to that cash value if you need it in your life. In this case, when you use premium financing, the bank has your cash value all collateralized, so you do not have any access to it. Even as it grows, you don't get access to it until you pay off the full loan from the bank. So I was watching a video that somebody sent me the other day, and it was about premium financing. You put in $54,000, or you put in $50,000 a year for the first 5 years. A bank puts in $54,000 for those first 5 years, and then the next 5 years the bank puts in the whole $104,000. That's $250,000 you put into the policy. You can't touch the cash value until you pay off that loan. That's $500,000, $750,000 plus whatever interest has accrued. Typically, the expectation is within 15 years. There should be enough cash value built up in the policy that you can pay off that loan. In their illustration, the assumption was 15 years you pay off the loan, and then 5 more years later you can start taking an income stream of $117,000 a year for the rest of your life. I compare that to you starting a policy that's designed how I designed them, which is high cash value, minimize the expenses. You fund it for the first few years, and then you just borrow from the policy to make the premium payments. Rather than borrowing from a bank at a variable interest rate, even though it's low, it's variable. Rather than doing that, you borrow from the policy at a fixed interest rate of 5%, and then pay it back in. Key, I answered your question first thing, so you'll have to start this over and listen to it. So go back to the beginning. It wasn't the very first thing, but it was, probably 10 minutes in. I answered your question already. So thank you for leaving me that question. Okay, so premium financing, and actually this kind of relates to your question as well. But so what I designed was a policy that I do. You put some money in. You can even borrow out the first year if you need to, in order to get to that maximum MEC limit, in order to get to max funded. And you basically do the same thing for 10 years, except you borrow from the policy and put it back in. And what I came up with was, after 20 years, about $170,000 a year that you could pull out. So there's a little bit of variables in there that were a bit different because I couldn't illustrate borrowing. Using the insurance company software, I couldn't illustrate borrowing in the first year. But I think it ends up being kind of a wash, and you don't lose control of that account. So, it may even be better than a wash. Because you don't ever lose control of the account, and you have that fixed rate. If the insurance environment changes and you start one of those policies and it's a variable rate, might have a hard time. Gaining in that type of environment. So something to watch out for. I hope you found value in today's video. If you'd like to find out more about IUL and whole life, check out these videos right over here, and we'll see you next time. Now go maximize your cash flow.